So if you look at next question, right? Next question again. Now we are here looking at forward price to earnings, right? Forward price to earnings, little tricky, but again you will be able to solve it. I'm pretty sure. Let's try to do it. Okay. So in this question, what is happening is that an analyst observes the benchmark Indian Nifty 50, right, stock index trading at a forward price to earnings ratio of 15, right? So you say forward price to earnings. So you are saying that okay, fine, it is VT ET plus one, right? Forward price to earnings now at 15. Okay. The index expected dividend, expected means next one. Expected dividend payout ratio in the next year is 50%. Index required return is 7.50%. Okay. So basically your KE is equal to 7.50%. Your GC, right, is very high, right? Next year. Your dividend again, and it is not actually, this is also tricky. This is dividend payout. This is not GC to be fair. It is dividend payout ratio. Now, this kind of things, since you are studying this topic for the first time, so you will be confused because suddenly a new term has come, right? They have given you your dividend payout ratio, right? Now, the question comes is that uh, what exactly is a dividend payout ratio, right? What exactly dividend? So, what you need to understand here is dividend payout ratio is a fancy name of a very simple thing. So in finance, as we go ahead, you will realize anything which is a payout ratio, etc. It's a ratio. So it's a dividend. So you are paying dividend, and then you are dividing by something. Dividing by your basically what is saying dividend payout ratio in the next year. So you're dividing by generally dividend payout ratio is in simple term dividend by earnings. But the question is telling you dividend payout ratio in next year. Dividend payout ratio generally is this, but in this question, please understand this is the beauty of CFA exam that CFA exam each word is very critical. In this question, the question says dividend payout ratio in the next year. So it means it is dividend divided by your earnings of the next year, which is if dividend is T, earnings is T plus 1. So this is given as 50% means 0.5. Now, once you have seen this, then it should suddenly strike you that oh, the question is trying to trick me. Question is very easy, but question is trying to trick me. So if you remember the formula was VT divided by ET plus 1, right? And I told you it is DT divided ET plus 1 KE minus GC. This was the formula, right? So this part is given as 0.5. So question is just trying to make the question look it very difficult, but it is very easy to be fair, right? Look, okay, if the analyst believes, right, if the analyst believes that the Nifty 50 index dividends will grow at a constant rate of 4.50%. So this is given to me now, right? The answer this is given to me 4.50%, right? So I was searching for it, but now I found it, right? 4.50%. Which of the following statement is correct? Okay, let's see. So if I solve this now, so now it is saying Nifty analysts should view the Nifty as overpriced, underpriced, or fairly priced. Okay, I'll answer that question also. Again, VT by ET plus 1 is equal to zero point 0.5. And what is KE? KE is 7.5%. GC is 4.5%. Right? So 4.50%. Right? Then if you solve it, right, you try to solve this part zero point 0.5 your divided by 4.5 uh, okay 7.5 minus 4.5, so the answer which is coming as 16.67, right? Now, so answer you got as 16.67. Okay. Then analyst observed, analyst has observed that the forward price to earnings, right? Analyst observation was, this was analyst observation. Analyst observation was 15. By your mathematical calculations, right, you got 16.67, right? So the idea here is, right, that if you think, right, now the question comes, how do I answer it, right? Because you are getting 16.67 mathematically, right? Your, you know, analyst is saying 15%, right? So it is underpriced or you're overpriced, right? How do you figure out that? Anybody can, conceptually understand, like, how do we answer this? It is underpriced or overpriced, right? Basically, your analyst is saying, so okay, so analysts should view the Nifty as overpriced. Analysts should you view the Nifty as underpriced or fairly priced, right? So, in simple word, like this is very confusing. A lot of students get confused. I'll try to give you a sense here, which will help you later also, right? See, one is analyst belief. He believe his belief is 15, right? One is calculation. Calculation is 16.67, right? So there are two things here now. Analyst is believing that the benchmark Indian Nifty 50 stock index trading at a forward ratio of 15%. But when he calculated, right, when mathematics worked, right, the forward price to earnings, right, forward price,
What do they mean by forward price to earning?
right,
What
so
they are expecting?
no, so okay, so it is basically it's similar like your forward P, right? Forward P by calculation is coming out 16.67%. Analyst might have calculated by his own ways. Maybe he has used some other ways, right? We don't know what he has used. By his own ways, he might have seen some charts, he might have used some other data, right? I have no clue, right? My calculation says 16.67%. And right now, see, the basic idea which you should always remember that whenever you calculate something by calculation, that is maths. And I always say to students wherever I teach that in finance world, we consider whatever comes by math as, at least for exams. I told you, right? In real world, things work very differently. But for exams, whatever comes out of maths, that is God. Right? That is God means that is truth. So this is the truth. This is analyst belief. He has done his by his own ways. How he has done this calculation, I have no clue. Neither I am interested also to know what he has done. For me, this is the truth. For me, the calculation, the maths is the truth. Again, real worlds will work very differently. But what I'm trying to say that in these kind of exams, CFA, FRM, CPA, whatever, that this is the truth. So truth is that forward price to earnings, right, is 16.67, right? Analyst belief is your 15, right? Now the question comes is whether it is your overvalued or undervalued. How do I decide, right? Now the question comes is that the fundamental input into the equation, right? Imply a forward price to earning of 16.67 rather than 15, right? You can answer this question by other way also, right? You can answer this question for other way also, that if you like, if you are getting, I will come to both points, right? You can now do one more thing. What you can do is that you say that, okay, let's, if analyst has taken 15%, let me put 15% as your forward price to earnings, which is VT ET plus 1. Then I should put same thing, right? Basically, my formula was what? VT ET plus 1. This is very confusing, guys. So that's why I'm trying to. Uh, Once you will understand, you will figure out. But first time, whenever somebody do it, they always get confused. So what I'm doing is that I'll say that, okay, let's see what analyst is saying. Analyst is saying that, okay, this is zero point 0.5. I'm putting the same value. Let's calculate. Let's calculate GC, the growth part, right? Let's calculate the GC, right? Using your analyst forward price to earnings. So KE is same 7.5%. GC I try to calculate. So GC, if I calculate from here, it will come out 4.166, right? Something like that. If I calculate GC by your analyst way, right? So since the analyst, uh, what you say, if I put it 15, right? Since that, if you solve for G, that yields us a result of your 4.661667. Since the analyst is saying that there is higher nifty dividend growth, right? If you see, if you do the calculation part, right? Now GC, which came out from 15, right? So this was analyst observation. Okay, this is analyst. Okay, which I should not write belief. I should write observation. I think that will be better word. Observation. So analyst observation was 15, right? In 15, the growth rate of dividend is 4.1667. When he did maths, right? When he did maths, the GC came out, in the market was 4.50. So basically, if dividend are growing at higher rate, you tell me, if companies or if any index dividend are growing at higher rate, right? Right. So what is the what you say? What is the expectation of future? The expect, if somebody tells you that the dividends are growing at higher rate, right? Uh, if you observe your data, you are observing it. Your observation says this much, your calculation says this much, right? So your math says this much, so you obviously believe the calculation. So you say that, okay, right now when i when I see market prices, when I see market prices, I see GC is equal to 4.167. When I calculate by maths, right? When I calculate by maths, right? Maths tell me that GC is equal to 4.50. So since math says, I tell you God, we believe in maths, we see, no, whatever we are seeing in market prices, that is not true. Maths tells us the right picture. We will believe in maths, right? Now, simple point is, you tell me, if current market prices is showing you less growth, but your calculation is showing you higher growth, you will definitely say na that, oh, this is so nice. Current market prices are not showing the true growth. Current market price is showing less growth. Current market prices is showing less growth, means people are not realizing the true potential of Nifty 50. True potential is 4.50. So it means it is underpriced. I know it's very confusing, but get a hang of it. The whole logic, right? Whole logic in both of, let me summarize in two ways. One way is, again, try to understand this kind of question will come a lot ahead in future chapters, right? And this will keep on confusing. One is, see, why are you learning CFA? Like, let me put it that way. Why are you learning CFA? You all are learning CFA to become good analyst. Right? Maybe you want to work in banks, that is one choice. Maybe you want to become portfolio manager, that is one choice. Maybe you want to run your own, investing firm, etc., that is one choice. What is the key skill of an analyst? Key skill of an analyst is to identify undervalued security, right? That is what Warren Buffett says. Na? Yesterday he wrote his last shareholder letter, right? So so ultimately, what is Warren Buffett's philosophy, right? I told you CFA is mostly Warren Buffett's philosophy, right? That you are identifying the undervalued securities. So the whole point of learning CFA is to become a good analyst, right? Identify undervalued securities. So to do that, we have two thought process. One is we observe market. One is we do the calculation by maths. Our reference point is always math. We believe in math because we say maths is God, right? So we believe in math. Now, when we observe the market, we are seeing the GC is equal to 4.1667. Our math says GC is equal to 4.50. So we will say that okay, market is not showing the true picture. Maths is showing the true picture, and maths is showing the higher growth rate. It means it is underpriced, right? If you look at your forward price to earning, market was showing 15. Your maths was showing you 16.6 something, right? 16.67, right? So market was showing you 15. Market was saying that your next period growth forward price to earning will be 15, right? This was market was showing you, but the real thing, right, which is maths, which is God, is showing you 16.67. So you will believe here. You will say, oh, it means market will rise more. You will say, no, oh, forward price to earning is higher. Means there is, India will see more growth. India will see more, the stock price will rise more. So let me buy this. It is underpriced, let me buy it. Right? So underpriced, let me buy it. Right? And just to simplify again, because you're doing it for the first time, guys, this kind of question always come in exam. They want to test your understanding. The whole logic, please understand, which I tell to wherever I teach this kind of subject. I always tell people that see, the whole world operates on one principle. If somebody tells you now that uh, define finance, if somebody tells you, can you define what is finance, or what is portfolio management, or what is your whole, why do you study CFA, FRM, CQF, anything you study, why do you study everything? Though, if somebody tells you that, can you define whole everything in finance in one line? So that one line which I have created is that the whole finance can be defined in one line, that is buy low, sell high. Right? This is the crux of learning everything. Right? You are learning CFA to do this. You are learning CFA or everything in finance to do this only, that how do I identify undervalued security and I buy it, then the price goes up, then I sell it and make a profit. Or you can reverse it, right? Sell high, buy low, right? This is your basically short selling. This is called short selling, or this is normally not allowed. This is generally in derivatives, right? You can do short selling also in stocks, also in intraday and derivative also, right? So this is little complicated version of the same thing. This is the easy version, this is the difficult version, right? But the one line answer to studying everything in finance, why are you studying CFA, is this: that you have to identify underpriced security, you have to buy it. When the stock price rises, then sell it. This is what Warren Buffett said now, when he said that, be greedy when others are fearful, and be fearful when others are greedy, right? So that this is the same logic, right? You buy when market crashes, you buy when people are worried, you buy when you get a security at a very cheap price, and kind of thing, right? So this is what we are doing, right? This is the whole point, and you will see again and again in CFA that, please keep in mind, people get very confused, so that's why I give this god and all that I write. The logic is this only, that always remember that this side is always right. Don't try to follow what market is saying. Market is emotional, right? Please understand why. You can, somebody ask, somebody can ask me that, sir, why market is showing different? Because market runs on emotions. Market, there are every kind of investor. Market has retail investor also, market has professional investor also, market has hedge fund also, right? Market has all kind of people, pension funds also. So every person when participate in markets, so everybody is doing a different thing, right? So this is where, you know market is moving as per, suddenly if, let's say something happens in US, market crashes, right? So because emotions overpower. Why something foreign in US should affect India, right? But it affects, right? It affects because emotions, right? Today, suddenly in evening, the this thing came out, right? Exit poll result came out right now. Gift Nifty, right? Gift Nifty is our index, right? Gift Nifty is up, right? Gift Nifty is up because it is showing that BJP government will win, right? So why it is up, right? Emotions, right? So this side is emotional, market is emotional. The whole idea of CFA studying is that you have to not be emotional, you have to follow the maths, right? So this is, I'm just putting it in too many words today, but the whole idea is this: that don't follow emotions, follow the math. The maths is god, right? And whole, in real world things work a little differently, but at least in the theoretical world, in the, what do you say, CFA FRM world, you need to do like this. In real world, you have to take care of emotions also, to be fair, because there is a breakout trading, there is, momentum trading. Momentum trading works on emotions, right? So you have to be very clear, right? So there are different kind of trading, right? Don't think that this is bad. Emotions are not bad, right? There is a way to trade emotions also, right? Euphoria in the market is traded through momentum trading, breakout trading. That's a different level of study, which will definitely, which is part of CFA also, but that will come in CFA level 3, right? CFA level 1, 2, there is no discussion about momentum trading and all that, right? So again, I've told you a lot of things, but the whole idea, because these kind of question you will see a lot. Again, we will do such an analysis. One is market price analysis, very emotional analysis. One is mathematical analysis. Every time we will consider mathematical analysis supreme, and we will consider that as better, and then we will say that, oh, mathematics is saying that your forward price to earning is better, it means today it is lower, it means buy it under price, right? So that's the whole logic. Okay, try to go and learn about it. Not very difficult, but yes, earlier you learn it, it will help you, because every chapter you will see such kind of question, right? And such kind of analysis they want from you. Okay, because I told you logic, right? Ultimately you are learning CFA for this one line. This is the crux, right? Like, whole CFA FRM CQF is this line: buy low, sell high, right? This is the only one line in finance. This is the one line in business also, right? To be fair, this is what business is, right? Whole world is working on this one line, right? If you see Apple products, right? Apple manufacture its phones in China and India, right? And sell it at, manufacturing cost is only 400 or $450, I think. It sells for $1,000, right? So the whole world works on this only: manufacture cheaper, sell higher, manufacture cheaper, sell higher. Okay. All right, we deviated a little bit, but that was necessary, because uh, you need to have this in mind very, very clearly. Okay. All right, this is done. And next one we do now. Where is the next question? All right, let's come here and discuss now. If you require an 8% growth, if you require, right, your requirement is 8% return, and you must invest USD 500,000. Okay, that's given. Which of the investment opportunity given below table you should you prefer, right? Opportunity one or two, right? And why, right? So the logic here is we have to kind of calculate, right, which opportunity gives us more value, right? And the best way to do it, we have to follow the that cash flow additivity principle. You have to compare the two opportunities, uh, you know and and then see, right, which one has your better cash flow, right? So if you there are different ways to do it, to be fair, right? There are different ways to do it. There is not a single way to do it, but the whole idea is that if you kind of, one way to do, I'll say, is that you subtract, right? Basically you have to compare the, 1 and 2 now. If you have to compare 1 and 2, you do what? You check how their cash flow differ. Same cash flow, no difference, zero, right? So no difference, so there is no difference here. Here you are saying the cash flow opportunity 1 is lesser, this is your more, right? If I subtract 195 minus 225, it is minus 30, right? Cash flow second period, again this is zero, right? So this is zero. Now last one, if I subtract 195 minus 160, right, it is coming as 35.008. Now I'm just telling you a hack, right? I'm just telling you a hack, very easy, because we learned the principle, right? Cash flow additivity principle was that if you have same cash flow, you should uh, trade at the same price, right? Both are equally good. But now I'm saying, okay, let me compare the cash flows, right? So it's similarly, right? The two friends who are discussing that I am making this much money. Then you say, now, okay, let's see who made more money in first year, who made more money in second year. Then you said, and then you realize that, okay, fine. When we compare it, right, simply by your subtracting each other cash flow, right, for 4 years, right, which we realize that, okay, if you find the present value of the this difference, right, uh, okay, then you realize that, okay, let's try to kind of, right, calculate that what is the present value of both things, right? So these are the cash flows I'm getting. Now I have got this cash flow. This is, I think this calculation is little off because this is 34.992, right? So if I now the these two cash flow are kind of there is no difference. So basically, this cash, if you see, first opportunity has 35 more, right? Second opportunity, if you kind of consider, has 34.992 more, right? So, but time period are different. It is t is equal to 3. This is t is equal to 1, right? Now, if you try to take the present value, right? In the first case, you try to go back, it's a t is equal to 1. So not even, so if you try to go back here, right, only, or if you don't want to make it so complicated, just you can do it full thing also, right? 195, 195, 195, right? Just calculate the present value of these three things, right? If you try to calculate the present value of these three things, what will happen? You will have 195, 1 plus your 08 raised to power 1, 195, 1.08 square, and 195 your 1.08 cube, but you have the present value of this minus 500 also. So how do you do it? The way to do it, the PV is equal to minus 500. Your PMT, the cash flow which is coming is 195, right? N is equal to 3, right? And I by Y is equal to 8. Then you compute your FV. If you compute your FV, you will get the answer. Similarly, if you go here, right, you can do for this one also, right? You do same logic. I'm just telling you both things, right? Minus 500, 225, 195, and your 160 point. This is the easier version. This is you don't have to apply any logic, right? You can do easier version by this, right? Then we'll come to the hack, right? So if I put it, PV is equal to minus 500, your cash flows are different now. Here, CF naught, CF1, and you CF. Here we cannot do like this also, right? So in fact, you you don't do like this, right? Okay. I think that will again create. You do what CF naught, CF1. I think that will be much better because both are similar, right? You do CF naught minus 500, CF1 is equal to 195, CF2 cash flow 2 is equal to 195. Both way you can do it, guys. I'm just trying to put it because here also I'm writing the same formula now. CF naught is equal to minus 500, CF1 is equal to 225, CF2 is equal to 195, CF3 is equal to 160.008. Right, so you can do like this. Just take it as a homework, like do it, practice if you can solve it. But when you will solve both of these in your calculator, you will realize that both ways the value is coming same, right? Both ways the value will come same, so it will be indifferent between the two opportunity, right? So try it out anyway, right? Whatever you want to feel. Hack here was that I was trying to put across was the differences. I was saying that okay, 30 is coming here. If I take 30 discounted by one, 30 point your 108. That was one. And another one was difference what 34.992, right? Divided by 1.08. This was 34.998, right? 34.998 divided by 1.08 cube, right? If I do it 34.998, right, or let's say 1.08 raised to power 3 is this one. I take 1 by x of that and multiplied by 34.998. So I get this value is 27.78, right? And if I do the previous one, right, your 1.08 and then 1 by x, and I multiplied by 30, sorry, 3, and into 10, right? This value also comes out 27.777, right, which is 27.78. I hope you got, like, there are two, three ways you can do the question, right? One is this is a lengthy method. One way is the lengthy method, which is this. You find the cash flows of all, you find the cash flows of all. Right? This is your lengthy method. One is the hack which I told you. Right? One is the hack I told you that if I subtract the cash flows, here the cash flow, here if I put it, here this guy was higher, T1 was higher, here T2 was higher, right? The opportunity 2 was higher. So what I have done is I am saying in a simple word is that okay, so the it all boils down to this logic that opportunity 1, you have 0 here and 30 here, 30 dollars or rupees advantage. Opportunity 1. Opportunity 2 is 0 and your 34.99 8, right? 34.992. 998 or 992? 992, right? 992, right? That's why some difference was coming, right? 992. If I take 34.992, so here I have to discount one period. So my value is 30.108. Here I have three periods. This is third period. 34.992 divided by 1.08 cube. So this is the difference between two, right? So both I solved, I get 27.77 and 27.77, right? So that shows me both are same. So I have given you this hack also. This is an easier way to calculate, guys. But again, you have to understand that thing, then only you can reach here. Longer way I also give you, right? Whatever you want to, right? Shortcut hack you want to follow, that you can do. Longer way you want to follow, that you can do, right? Not a difficult question. It's just a tricky question.
Does it not matter that one is positive and one is negative? Would it
No,
not
no,
cancel out?
no, not. See, this is here 19. See here, if you see, it is what are we discussing here, right? If you see, here this guy is less, right? 1 minus 30, right? Here this guy is whatever, like symbol doesn't matter, right? To be fair, basically here this guy is 34.92 stronger, right? So the idea is they here 34.992 is better than opportunity 2. Here your opportunity 2 is better, right? If you see here, it is 225 now, it is bigger. So here opportunity 2 is better. So actually opportunity 2 is that 30 wala, right? This is opportunity 2. This is opportunity 2. This is opportunity 1. See, it will not be cancelled out because timings are different now. See, whole idea of studying the time value of money or the calculation is to show you that different time periods cannot cancel out. Only same 500 were cancelled out because they were same period, right? 500 cancels T0, 195 cancel T2, but T1 is equal to here opportunity 2 is better, T3 opportunity 1 is better, right? So they cannot cancel out, right? They cannot cancel out. You have to find out the time value of money of these, and that is what I am doing, right? I'm saying that okay, rest all is equal. If I have to do a comparative analysis, here $30 is higher in opportunity 2, right? So the value comes out at 27.7. Opportunity 1, the last one is better, 34 point your 992, right? That is better. So that is the advantage, and that's why I get it, right? So it will not be cancelled because time periods are different. One is T1, one is T3, right? When time period are not same, it will never be cancelled. Okay, that's the whole idea of time value of money study. But again, there are two hacks here, both ways. This longer way you can also do it, I'm not denying it. This is generally people do like this because hacks people don't remember, right? Generally people follow this method. That is also totally fine, but it's just a time consuming way, right? It's just a time consuming way. Otherwise, you know no, if you can't remember hack, just follow this normal calculation, input in calculator very fast, cf naught, cf1, cf2, cf3, calculate the present value. Here also calculate the present value, both will come out same. That also you can do, right? There is no problem in that. I have given you a hack also because in your book, right, they have given a hack, so I just wanted to cover that. Okay, so very interesting question again. Concept is easy, but the questions are quite tricky. Okay, CFA level 1 has become kind of default, right? What I'm trying to say is today I got a message from a Delhi University student. Uh, so that person was saying, sir, that person has already done FRM1, right? With me only. I only taught FRM1. Now that person was saying that, sir, suddenly I've realized that all the companies which are coming to my company are asking for CFA level 1, right? So I want to do CFA level 1, which, so CFA level 1 has become very default kind of requirement of lot of, hiring now. Okay. So keep that in mind. The curriculum is good. That's a very solid point. Okay. All right, let's go ahead, guys. I think this is pretty straightforward because there is no difficulty here. Okay, so uh, in this question, what has been asked? You have been asked in very simple terms. You've been asked Italian 1 year government debt, right? Italian 1 year government debt has an interest rate of 0.73%, right? Italian 2 year government debt has an interest rate of 1.29%. The break even 1 year reinvestment rate 1 year from now, right? Again, this fancy word will always come. You have to be smart enough to realize that where to focus, where not to focus, right? So when you see that 1 year is given, 2 year is given, and they're asking for 1 year from now, right? So make a timeline, right? So 1 year is given, 2 years is given. 1 year is 0.73%. This is the spot rate for 1 year. 2 year is 1.29%. The question is asking the break even 1 year investment rate 1 year from now. So question is asking this one, right? And how it is written generally F12, right? Forward rate from 1 to 2 year F12. So F12, if I have to find out, how do I find out F12? So formula was what, right? Whenever the whole thing, right? The whole thing I had 1 plus S2 square was multiplication of this into this. Na? So 1 plus your S1. S1 is given. Now 0.73 is S1 only. 0.73, right? And then F12. 1 F12, right? So 1 plus 1.29, right? This is 2 year. 1.29% square divided by 1.073. And you can say minus 1 is equal to F12, right? If you solve it, you will get the answer, right? So that is that calculation is for you guys to do, guys, because that is how you will become perfect. I can do the calculation here, I don't mind, but what I'm trying to put across in very simple term is that calculation F12, yeah, F12 is 1 year, 1 year, right? F12, right? I'm writing it in a simple way because this is how I do the question. So if you're getting surprised, basically what I'm trying to say, I get confused. See, 1 year, 1 year, 2 year, 1 year. Even though it's not difficult, right? So, but I prefer like this. Okay, 1 year, 1 year from now, I write it F12, right? And this 2 3, right? I write it 2 year, 1 year. I write it F23. So I know F23 gives me very clear, right? Now it start at 2 year, end at 3 year, right? Start at 1 year, end at 2 year, right? So F12 is nothing but 1 year, 1 year, right? It's just a my way of writing, nothing else, guys. I have a habit of writing like this, nothing else. If you want to write like this, your choice, right? I'm not stopping, but personally, I feel this is very easy. F12, F23, it becomes very easy to write, right? Nothing else. So this is F12, which can also be called 1 year, 1 year. F23 start at 2 year, end at 3 year. So 2 year, 1 year, right? So by this notation, it becomes very. If I write it F46, I know that, right? It start at 4, end at 6. It's a 2 year thing, right? So it is very easy for me to understand 4 year, 2 year. Okay, so I'm just giving you an example why I use this notation personally. Right, it's not your exam notation, but personally I use this notation in FRM also, CFA also when I solve questions, because it is kind of easy to understand. Okay, so this is what we had. Very easy question, looks like a difficult question, but not at all difficult question. Yes, you have to be absolutely clear of how to find out. And we are doing as such all kind of question, at least that's our endeavor here, guys, that we want to cover all kind of difficult questions, right? So this is what we have. So again, I had done the same thing, right? 1.029 square 1.073 minus 1 is equal to F12, or right, 1 year, 1 year. Okay, so that is what we have, right? How can one write in this notation if 1 year from now, 1 year from now? for 3-year loan, right? Yeah. So 1 year from now, F14, na? You're correct. 1 year from now, three-year loan, right? So one is the starting point of the loan, four is the end point of the loan. 4 - 1 is 3-year loan, right? You write F, yeah, right. One, no. See, it will be F14, right? 4 - 1 will be the duration. If not F13, F14, right? Why I'm saying is, see, okay, let me write down here. Not difficult, right? See, the whole idea is generally if F23 is given, it means loan starts at 2 year, ends at 3 year. That's it. Now, if somebody asks what is the duration of the loan, duration is 3 - 2 1, right? So I'm not counting duration. Duration you have to calculate. I'm just, why this notation, I like this notation because personally speaking it becomes easy for me, na, that okay, it is starting at 2, ending at 3, okay, F23. I don't have to think, right? So if you are asking me that, okay, sir, 1 year, there are 4 years, 1, 2, 3, 4, right? You are saying that, sir, one year from now, 3 year, right? Starting here, ending here, okay. Starting here, F14. Then somebody asks me, what is the loan duration, right? How many duration? Then I say, oh, duration, 4. It is ending on 4, starting at 1. 4 - 1, 3. Right. So I love it. I love this method 1 4 because it is directly picking up here. It starts at 1, end at 4. You give me any number, it will be very easy. Let's say somebody says, uh, you know, loan starts at second year, right, and ends at fifth year, right? Okay, second year, fifth year. Okay, fine. F25. What is the duration? Okay, duration of loan is 5 - 2, 3 years. Right, so it helps me, right? Directly you can put 2 for 2, 5 for 5. That is why I use this notation, because this is easier. 1 year, 1 year, 2 year, 1 year, that is not difficult, I would say, but they just time consuming, I would say. Okay, nothing else. Okay, the current exchange rate between euro and USD dollar, right? Again, please understand, it is given me USD by euro, right? It has given me the current exchange rate USD by euro is given to be 1.025. Again, euro is 1, right? USD is higher, so it means 1 euro to 1.025 USD, right? The risk-free interest rates, right, for 1 year are 0.75% for the euro. So interest rate of, so this is your price currency, this is your base currency. Interest rate of your price currency USD is 3.25. Price currency is 3.25%. Interest rate for base currency is 0.75%. Right? The 1 year USD euro forward rate that best prevents arbitrage opportunity. Okay? So we want to now know that what is that particular thing which prevents the your arbitrage, right? So if that is the case, what do we do, right? So how do you solve it, right? Very simple. I don't think you need to worry too much, because the formula gives you a clear idea. Forward by spot, right? Forward by spot, 1 plus interest rate price currency plus 1 plus interest rate base currency, right? So that if you have that formula, I think that will help you. Forward by spot, 1 plus interest rate price currency, 1 plus interest rate base currency, right? So if that is the logic, so 1 plus interest rate price currency is 0.0325, right? 1 plus interest rate base currency is 0.0075 by 100, right? And 100 more, right? 0.75, 0.0075, right? And forward, we have to find out. Spot is given to you as your 1.025. So ultimately, it boils down to 1.025, and when we solve it, 1.0325 or 1.0075, right? So if I solve it in my calculator, so 1.0325 divided by 1.0075, right, into 1.025, 1.0504, right? It is coming out as 1.05043, right, which is equal to your 1.051, right? So this is the answer, right? So this is a very simplistic kind of formula. When we'll go ahead, you will realize there is exponential also and all that also added. But right now, I'm not going there because again, those are difficult formulas which you see ahead. But since this is early part of your syllabus, just understand that this is how it is solved. 1.051, right? So answer here is A. Okay. Again, not a difficult question. If you know the formula, if you know the understanding, I don't think there should be an issue. Okay. Okay, let's do this first. Okay. A stock currently trades at USD 25. Okay, so this is your stock price 25. In 1 year time period, it will either increase in value to USD 35 or decrease to USD 15. It means two possibilities it is given. Either it goes to 35, either it goes to 15, and that to t is equal to 0. This was t is equal to 1, right? So it is a binomial tree being made, right? So you clearly get an idea. Okay, this is a question of binomial tree. An investor sells a call option on the stock, granting the buyer the right to, but not the obligation to buy the stock at USD 25 in 1 year, right? So investor sells call option. Investor sells the call option. Okay. At the same time, the investor buys 0.5 units of stock, 0.5 units of stock. Which of the following statement about the value of the investor portfolio at the end of 1 year is correct? Now, see, what is the action investor is doing? Investor is selling the call option, and then investor is buying your, what you say, is the stock, right? So he's buying the stock and selling the call option, right? Now the question comes is that what is the price he's buying and selling, etc., right? So let's look at that. So if you see here, have they given an USD 25 in 1 year? Investor sells a call option to buy the stock at USD 25 in 1 year. So this is your strike, guys. This is X, right? I know you will say, sir, how it is strike? Just keep in mind, investor, when he's saying that he is granting the buyer the right. So he, at this price, when you're granting buyer the right at this price, this is called strike, right? So strike is 25. So if I now calculate the value here, just look at this part. Just look at this part. Currently stock price 25. It can take 35 and 15. Now at 35, I have two options. I am buying a stock which is 0.5 into 35, right? And I am selling a call. What was my call? What is my call value? Call value, I told you, right? Call value is what? Call value is max of s minus x comma 0. Max of s was what? S was 35, x was 25, comma 0. So call option value was 10, right? And here This part max. So at each node you have to find out. Here it was 15 minus 25 comma 0, so it is 0. So zero point 0.5 into 35, at 35 I have to find 0.35, zero point 0.5 into 35, zero point 0.5 units. So what is happening is, what have I calculated here? What is this? This is my value of call value. This is my portfolio value which I am calculating. Portfolio value I have to calculate. I have to take minus 0.5 unit of stock, zero point 0.5 into 35, minus your 10 because I'm selling it. I'm buying, I have bought 0.5 units of stock, sold, right? Minus 10. Here I'm doing what? 0.5 units of stock I'm buying, and here call option is 0, minus 0. So if I solve it, it is what? 17.5 minus 10, 7.5, and here it is 17.5, right? Right, it's 17.5, right? So what is the answer? What do we get here, right? What is one answer? One value is your what do you say? Okay, sorry, zero point 0.5, not zero point 0.5 into 35, zero point 0.5 into 15, because the below one is 15. Now I am taking 35, 0.5 into 15. 0.5 into 15, it is again 7.5, right? So 7.5. So in both cases, the value comes at 7.5 in both scenarios. And I'm pretty sure both of you would have been totally confused by now. But now,
So
let
what is, how can it be calculated without knowing the probability of
okay,
each?
okay, okay,
And the second thing is the second binomial tree that you have made, where it says 0.5 multiplied by 35 and then 0.5 multiplied by 15. So what is that 0.5 for?
okay, fine. So just understand this question. Will not go more deeper than this, right? Again, now let's put it. See, okay. See, the idea is that options, I told you, are derivative contracts, right? Options are derivative contracts. Options generally are purchased with the stocks. So you have a portfolio. When you make a portfolio, you have stocks also, you have options also, right? Generally, you have everything: stocks, forward, option, everything, right? When I have to calculate the value of portfolio, I have to, you know, if I am holding stocks, if I am holding stocks, then my value is very simple. Whatever stock I am holding, n into stock price. Life is very simple. When it comes to options, options value calculation is little tricky, because if it is a call option, then it is max of s minus x comma 0. The put option, it is max of s minus x comma 0, right? Depending on whatever situation I have, right? Now, it is asking the which of the following statement or value of the investor portfolio at the end of 1 year is correct. So we have to talk about value of portfolio, right? So it is stock holding plus options. What is the option we have? Uh, we have a call option, right? So now, what is the question saying? Question saying that if you read this question, investor sells a call option. So that thing is clear to mind. Okay. So my portfolio, if I am now writing, my portfolio is that I am selling a call option. So okay, fine. So I sell a call option. When I sell a call option, so it is sell is negative. Please keep in mind. Sell means negative. It is decreasing my portfolio, right? When buy, my portfolio is increasing. So sell is negative. So I am selling of call option minus call option value. Okay. And granting the, so this is granting the buyer the right, etc. That is just the definition, right? To buy the stock at 25. Now, this is exercise price. I'm not explaining it too much, but just remember, when you grant somebody a right to buy and sell at the some price, that is called X. So this is S, this is X. So it is given to you, S is 25, X is 25. X could be anything, but here it is 25, right? Okay. Stock price today, S naught is 25, X is 25. right? So S naught is stock price currently trading, today's price, S naught. X is strike price, right? Now it is saying at the same time, listen to me carefully, at the same time, the investor buys zero point 0.5 units of stock. So, okay, investor is buying zero point 0.5. So, zero point 0.5 into stocks, stock price. So, my value of portfolio is equal to zero point 0.5 into stock price minus call option value, right? So now if I see value of my portfolio, so this part is clear to me, right? Zero point 0.5. Now stock price I don't know, right? Why I don't know? Because the question is asking me 1 year from now. Question is not asking me stock price today, because question is asking me value of portfolio at 1 year from now. So I need stock price also 1 year from now. I need call option value also 1 year from now. Okay, both things 1 year from now, na? So I don't. So let me find out what is the stock price 1 year from now and what is call option 1 year from now, right? So that is what I am trying to find out. So call option 1 year from now, right? So that is, these are the two things I have to figure out now. Okay, so if I have to figure out these two things, so first of all, I start with the binomial tree model. So S, this was 25, right? Now they are themselves telling us, they are. I know your question is, sir, if you don't know probability, how are you finding? See, the question itself is telling me, right? It will either increase to 35 and either increase to 15. Your question is very legitimate. Your question is very right, that how can I find out 35 and 15 without knowing probabilities? Actually, you found out 35 and 15 by knowing probabilities only. When you will go to derivative chapter, they will tell you how did you calculate 35 from 25. But right now, just to make your question easy, they have given you that, okay, at t is equal to 0, price was 25, t is equal to 1, stock price was 35 or 50. So SU is given to you, S up and S down is given to you. How they calculated, it is none of my concern right now. They calculated by some way, they have given me in the question, I am very happy about it. Why should I bother? Right? So that is my concern. Right? So that comes out. So the thing is that, okay, so now if that comes out, I am pretty happy that, okay, I have found out, if I have to calculate, you see, at the up node, and the value has to be calculated each node. If I have to calculate the value here, so it becomes 0.5 into 35, because price from 1 year from now is this, but I still don't have call option value here, right? What is the call option value? Let's call it A and B. I don't have call option value at A, right? I don't have that. Here also I found out zero point 0.5 into 15 I found, because it's 15. Stock price 1 year from now in the down node. This is called up node. This is called up node, right? Up node, I found the stock price is 35. This is called up node. Up node. This is called up node. Up node, the price was 35. I used it. Down node price was 15. I used it. Price was 15. I used it. But this is A. I don't have the value. Similarly, here also I don't have the value, right? Similarly, here also, right? I don't have the value. At your B, I don't have the value. Now my question, next part is, let me calculate the call option value at A and B. So now to calculate call option value at A and B, right? So I know I need to know stock price. This is 25, this is 35 and 15. I told you, and S is equal to 25 was given, right? S naught. X was given as 25 also. So I know told you call option value was max of S minus X comma 0, right? So max of S was this 35. I have to take the S price at the this node, which is 35. X was constant 25, right? So 25, right, comma 0. So this price comes out to be 10. Here it is max of your s minus x comma 0. This is for call, guys. If you have to put, it is x minus s. Right? How it came, everything we'll discuss in derivative. Max of your 35, sorry, not 35, yeah, 15, because take this price, guys, don't get confused. You're, see, you don't have to bother about this price, because this is at this node. When I reach here, I'll talk about this, but I'm now right now at here in this t is equal to 1. So let's talk about t is equal to 1, not t is equal to 0. T is equal to 1. So max of s is 15, x is 25 comma 0, which is 0, right? So this is 10, this is 0, right? 10 and 0. So I found it, oh, 10 and 0. Perfect. Now let me put that in previous question. So this is what I got it, right? This is what I was searching for. So this is zero point 0.5 into 35 minus a node, the value was 10. So 10 minus 0.5 into 35, 17.5 minus 10, it is 7.5, right? So this is my portfolio value. What did I calculate here? This is my portfolio value, right? Portfolio value, stock into N minus call option. Similarly here, right? What was my value? Zero point 0.5 into 15, 7.5. What is the call option value? Call option value is 0, right? Call option value in down node is 0, right? 0, which is 7.5. So in both cases, you found out, in both cases, you found out it was the same value, 7.5, right? So that's why we tick mark the option when we go. The portfolio value has a value of USD 7.5 in both scenarios, right? I know it's tricky. Especially, that's why Pratik, go back and see your WhatsApp chat. There was a reason Pratik dropped this message, because when you see such kind of topic initially in the first few days, you suddenly get worried that why it has become so difficult, why I'm not able to understand, because there are a lot of new things coming up now. I think the basic doubt will come to myself, from where did you get this? So there's a logic to it. There's a huge logic to it, but I'm not going there for a reason, because that's a derivative topic, right? We'll cover that, right? Similarly, this is for call. Had it been a question of put option, this was call option, guys. Had this been a question of put option, the formula would have been max of x minus s comma 0, right? So there is a logic to it, there is a funda to it, and value of portfolio we are trying to calculate 1 year from now, right? 1 year from now. So stock price also 1 year from now, right? Option value also 1 year from now, right? And then each node, the price you found out 35, you put it here. Call option value you calculated below, you put it here. Price you put it here. Call option value you put it here, right? This is it, you have to learn, guys.